Hello! Recording this video to take you through some pre-year end tax planning. So I hope you're doing well. Thank you very much for taking the time to join me. And hopefully there is some useful content in here, even if it's just a little refresher. The thing is with tax is so complicated and nuanced, and that even when we do learn things, myself included, often we need a reminder. So now we're a little over a month out from the end of the tax year, the 5th of April, and so what better time to have a little review through what we should be thinking about at this time. Right, so if I just start with a little, what's new for 2025? So CGT rates increased. Obviously, I did updates on that late last year. Since the autumn budget, we had the standard rate of capital gains tax, which was 10 and 20%, has increased to the 18 and 24% to align with what was already the residential rates for capital gains tax purposes. So we didn't actually see a move or an increase for residential landlords, which is rare. They were penalised in many other ways though. The FHL regime ending. So what does that mean? Well, if you got a holiday let, you had sort of like a hybrid in between a trade and an investment, which is the standard buy-to-let model. For tax purposes, you had that hybrid in the middle, which meant that you had various tax benefits. Won't get into all of them, but I'm thinking here predominantly in finance costs being fully allowable rather than only the 20% credit, as well as other things like various business-related relief, business asset disposal relief, rollover relief, and capital allowances. And so just thinking about this, bearing in mind that from April 2025, that will be gone and it will all be under the sort of standard investment property banner. Are you set up optimally in terms of should you review your ownership structure of how you own those FHLs? I know we've helped lots of clients on that because we sent updates on this late last year. Also, capital allowances, super important. This capital allowances that are claimed prior to April 2025 can be carried beyond that period, so that is a very important point for you to bear in mind. Certainly, if you think about, what should I do before April 2025 if I have an FHL in my own name or not? But especially if it's in your own name, you should definitely think about capital allowances if you haven't already. It is a specialism in and of itself, so you need someone who specialises in that area. Surveyor comes in and everything like that, but worth looking at. Non-dom overhaul, so won't go into too much detail here, but essentially if you are not born in the UK, it's the most common form of non-domiciled, but you are tax resident here, so you were born, so you do live here in the UK, then your overseas assets and income may become chargeable in the UK, so that's something for you to definitely, is a big change, so it's something for you to be mindful of. If I just move my head out of the way there. SDLT increasing, so I mentioned that residential landlords weren't detrimented here, but they were here. So an additional 2% on top of the already 3%, so you've got a 5% ADS, additional dwelling supplement now. Interestingly and crucially though, from April 2025, the stamp duty holiday that was brought in at COVID is coming to an end. What that means is that instead of stamp duty kicking in at 250k, it's now going to come in at 125k. It doesn't actually make a massive difference, but again, it's another cost that we need to factor in. And as we make our money when we buy with property, making sure that we understand what all those costs will look like is essential. Okay, so let's look at some basics. So ISA allowance, super important. If you can afford to, utilise your ISA allowance for yourself, your husband, wife, kids. Junior ISA allowance, 9k. Quick whiz to ISA, completely tax-free wrapper inside. Any income or gains inside there is tax-free. Also accessible at any point, crucially. Don't get tax relief on the way in, but there's no tax charge on the way out. Does form part of your estate when you die for inheritance tax purposes. Capital gains tax allowance, 3k. It's not very much. It was £12,300 not too long ago, but anyway, we are where we are. But if you've not used this and you do have assets pregnant with some gains that you maybe would like to dispose of or whatever, then you're bearing in mind all of these allowances are on a use it or lose it basis. You either benefit or you don't. Pension, 60k allowance. It was 60k last year as well, and it was 40 for the years prior. So if you had a pension set up but you hadn't contributed to it, then you could, in theory, bring forward up to 200 grand's worth of allowance. So if you had, let's say, a limited company, a trading company, or whatever, set up that had excess cash, you were wondering what to do with it, might be something to look at, because it was massively, massively save you on corporation tax. We've advised on a client recently where it saved them, what was it? It was, getting on for 100k total. So yeah, no, definitely something to think about. And also, if you just think about it, it's the trade-off, isn't it? Do you go pension or ISA? I get that question a lot. And I think a good way to answer it is that it's neither one. It's not a binary choice. It should be it should be, if you think, so I explained the implications of this. There was no tax relief on the way in, no tax charge on the way out. You can access it whenever, and it's tax-free inside, and it forms part of your estate when you die. Pension, you get tax relief on the way in, 20% top up from the government, plus if you're a 40 or a 45% taxpayer, then you get more relief. You get relief at your marginal rate of tax. So it could be 40 or 45% tax relief on a contribution. That is very tax efficient. Great. Inside, when it's inside the pension, tax-free as well. That's the same as the ISA. But when you lock your money away here until retirement, that's a downside. Plus, when you do take out, you get the 25% tax-free, but then anything over and above that, you have to pay tax on pulling it back out. Now, obviously, the idea in terms of benefiting from that is that if you are getting tax relief today at 45%, and then when you retire, you're not a 45% taxpayer, you're paying tax at 20%, then obviously, even though there's a charge on the way out, you're still net benefiting from the tax relief from the government, if that makes sense. The relative benefit between ISA and pension has tilted towards ISA because, of course, from 2027, pensions will form part of your estate for inheritance tax purposes. This wasn't the case previously. So one of the extra benefits of pensions over ISAs was always the case that this would sit outside of your estate for inheritance tax purposes. Super useful. But obviously that is being phased out. So frustrating. But it means that, if you can afford to, ISA allowance for sure. If you're a higher or additional rate taxpayer, pension allowances should be considered, especially if something applies that I'll explain in a second. Dividend allowance, also meagre, £500, like the CGT allowance. It's being dwindled. Lots of things of late in the UK have just been maintained, like thresholds and things, which causes something called fiscal drag, which is like, tax rates aren't going up, but actually you're paying more tax because you're earning more money, and the rates are frozen. So like the 50k basic rate band, for example, I'm thinking of there. The personal allowance at 12.5k has been that way for a while. I could go on. There's lots of things like that. In fact, I'll mention more as we go through this presentation. But if you've not utilised your dividend allowance and you have shares upon which you could issue a dividend, you should do it. Again, use it or lose it. £500, £500. That's better than nothing. And at the end of the day, you've got to look at the accumulation of this year on year. When you utilise those many years into the future, that's where you get the benefits. Right, income tax tips here. So this is looking at rates of tax. So that is an eye-watering rate, 60%. And the reason why it happens is you've got the 100k trap. So when I mentioned, you basically lose your personal allowance. So the 12.5k personal allowance that you get, you lose £1 of it for every £2 you exceed over 100k. So once you get to like 125k, you've lost all of your personal allowance. So that means basically, we looked at this for a client the other day in terms of some pre-year-end tax planning, and it was like if they put, they had to put like about, well, you just do the maths on it, but it was less than 5k they had to put in, and then they would get essentially a 10k worth of pension contributions after tax relief is considered as well. So the government puts in 20%, plus they get an additional 40% relief through their self-assessment. So it's just an absolute no-brainer. The thing for you to be conscious of at this point, at this time in the year, is what is my total income going to be? A lot of people who get caught by this actually have earnings of 80 or 90 grand, and then they get a bonus in the final month, and they don't realise they've been caught by it. Now, it's just really important because pensions can't be retrospectively contributed to. You need to do it before the 5th of April. So you just need to be extremely mindful. Is there a bonus coming in March? If there is, can you salary sacrifice it if you're employed? If you can't do that, then you need to think about making a personal pension contribution to avoid the 100k trap. Super important. And the reason why that works is the loss of personal allowance is calculated based on your adjusted net income, which takes into account gift aid contributions, so contributions to gift aid qualifying charities, and pension contributions. That's why it's very, you can imagine if you got 60% relief on a contribution into a pension, it's incredibly worth it, and you're not going to pay 60% when you draw back out in the future. So yeah, again, if we go back to here, it's a combination of these two. If you're up above 100k, you probably want to prioritise the pension contribution, to be honest. But if not, or if you've done that already and you've got more left over, ISA too. Awesome. Capital gains tax. Is there anything useful in here? Well, it's just I think I've gone through it already. Using AI to produce images is very odd, isn't it? Capital annis tax. That's not a word. Yeah, we discussed this. Yeah, I mean, yeah, don't let the tax tail wag the dog is something that comes to mind here. But yeah, self-furnished holiday lets. Yeah, I mean, restructure might be something that you think about. Inheritance tax becoming increasingly important. Plan for this. Not least, I mentioned fiscal drag. Allowances frozen until 2030. These two allowances here. I think that allowance right there, 325k nil rate band, even though this has come in the intermittent period, has been that rate since 2009. So you think how much assets, property has increased in value since 2009, and then you think, wow, that stayed the same level, and then you think how many more people then just naturally through natural property price increases are paying inheritance tax without planning. So inheritance tax is extremely important. Clients at IWN Accountancy are going to benefit from, we can do an IHT review and a benefit from a reduced rate versus clients who just come to us just for the IHT review. This is becoming very, very important. To maintain this, a tables from 2 mil, so keeping your estate underneath 2 mil is super important. As is, yeah, making gifts. You're starting to plan for the pension side of things. Yeah, things like normal expenditure out of income, and won't go into any more detail there, but definitely reach out to us if you have got a sizable estate, and it doesn't have to be that big anymore because this has been frozen. If your estate is pushing the mil plus, then you probably want to be thinking about some sort of planning, or if you think it will ultimately reach those levels. And yeah, it's ultimately how can you make sure that your family benefit from what you've built, and you transfer as much as possible through generations. We pay enough tax in our lifetime, so if we don't plan here, then we can get caught unawares. This is an important thing to be thinking about. The profit extraction for business owners. So there's some overlap here over what we've spoken about previously, but charging interest on DLA. I mean, lots of clients of IWM will already know about tax efficient profit extraction, so they'll probably have they'll have a low salary, they'll have a higher dividend depending on how much total income they want to take out the company, let's say. Another thing for property investors specifically is charging interest on direct loan accounts. So this is super important because you often lend cash to your company, seed capital, in the form of a director's loan, so that you can put a deposit down on the house and buy it, etc. And so the company owes you cash. And so for especially for retired individuals who may have that set up, aren't earning anymore, they might have a small state pension, or they might just have no pension, the property might be their pension, and they might just be taking a low salary from their company, then you can set up a scenario where you have, instead of the 12.5k tax free, it's topped up to 18.5 grand. You get an extra 6k on top of tax free interest. That's obviously tax deductible in your company, so that is very useful. Obviously dividend, yes. Optimal salary, so you always want to make sure you hit that if you're not getting your state pension credit elsewhere. Yep, cool. So on the non-dom reform, there's a 4-year exemption, then it's full UK taxation, so there's a transition period where you need to be thinking about this if you are in that camp. FHL benefits end, we've spoken about that, but essentially you used to get gift relief, gift holdover relief, rollover relief, and business asset exposure relief. That's going to be ending from April. Gift relief meant that you could transfer the property to your children, let's say, and even though that would normally be chargeable to capital gains tax, you wouldn't actually have to pay any capital gains tax because they could just inherit your purchase price, your base cost, basically. Okay, stamp duty surcharge, we know about this. One important point there, I suppose, is the relative benefit of commercial property has increased again, because not only does the commercial property not pay the additional dwelling supplement, it also has just lower rates anyway. Pensions, IHT, so you've got to think about that from a tax perspective, like we said, but also in liaison with your financial advisor. How does that change your sort of financial plans over the coming years? And employers and so that's, you'll likely be aware that it's to increase from April 2025, and then the degree to which that impacts your business is highly subjective. We can help though. We've got like a calculator if you want us to help you to work out what that looks like. For smaller businesses, it can actually be beneficial, the change, or impact slightly negatively, and then the larger the business gets, the more adverse the impact. Especially when you get like in hospitality and things like that, especially when you combine that with the increase in minimum wage, then it can be quite a painful change for the business. Okay, so action plan. So review, check your allowances and income with us. Feel free to. The important thing is knowing. Firstly, it's measuring, then enables planning. So knowing where you are at for the current year, where you're likely to land. If you're going to marginal rates of tax, super important. So are you going to come in just above the 50 grand mark, where you might pay some higher rate tax and or lose things like child benefit? And if that's the case, what we're going to do about that? That's something to consider. Sorry, I just had to pause it for a second there because I had a lingering thought in my mind. When does the child benefit tax charge kick in at 60k? It was for this tax year. So yeah, if you're over the 50k mark, you're going to be thinking you might be paying some higher rate tax. Okay, what do you do about that? The pension contribution can be something useful to consider. If you're going above the 60k mark, then not only will you have some higher rate tax pay, but also then you start to lose your child benefit entitlement. So that's if you or your partner is claiming child benefit, whoever's the higher earner gets the tax charge on them. So again, that's something that a pension contribution can help. But it's just like knowledge is power. Knowing that in advance enables you to plan for it. If you don't know it, then you just get these sneaky, unpleasant surprises, which is never nice for us to have to help and deal with it after the fact. Tremendous. What else was I going to say? So act, use release and allowances before 5th of April. Don't lose them. Yeah, correct. There's other things that we've not mentioned here, like stuff like higher risk but more tax efficient investments, such as like enterprise investment scheme, seed enterprise investment scheme, and venture capital trust, which basically give you like up to 50% tax relief on making the investment. Extremely attractive. That's the seed enterprise investment scheme. The other two only give 30% only. Not a bad return before you started. But obviously they're higher risk investments, so they're not for everyone. They're for those with a higher risk appetite, but or higher earners who have got significant personal tax liabilities, and then they're going to get a nice amount off or a repayment, whatever. Yep. So again, thinking about preparing, thinking forward to the degree that you can, and then contacting us, your advisor, whoever, just making sure that I think even if you understand a lot about tax, and some clients do understand like 80% of the total picture, and that's tremendous. But there is the saying that a little knowledge is dangerous, and I think even like you could understand 90% of everything, and then it could just be that final 10% that kind of undoes the strategy. So it's really important to run it by someone, a professional, and just kind of, even if it's as a sounding board, but certainly to hopefully add extra value to to your plans. There we go. Good stuff. So thanks so much for watching. You can ask us anything if you've got any concerns, or you need any support, you would like to discuss your circumstances with us, please reach out. It will be an absolute pleasure to help you. And yeah, hope you have a nice rest of your day. Cheers.